We believe in financial transparency, so today, as part of our monthly portfolio update, we're going to go through everything we own and why, plus how it's all been performing. Welcome to our monthly portfolio review here at Equity Mates. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this portfolio review. As you said, we believe in financial transparency, and I think it's a good process for us as well, you know. Keeps us accountable to keep investing, to keep thinking about what's in our portfolio, knowing that we are going to be sharing it publicly.
Yes.
So hopefully it leads to better returns, but hopefully for people watching who are a bit nervous about, you know, how to get started, a bit overwhelmed about the amount of choice that's out there, hopefully just seeing how we invest can give you some direction and some certainty that it isn't too complicated. Your portfolio doesn't need to be overly complex. Keep it simple, stay consistent, keep investing over your lifetime. That's all you need to do.
That's it.
But we should say, it's important to say right from the top that we're going to be sharing a lot of positions that we own, companies and ETFs that we own, but we are sharing it for education purposes only. We're not aware of your personal financial circumstances, your goals, your risk tolerance. So what's right for us may not be right for you. And also, we just might be wrong, you know? So
unlikely.
So take this as education and then do your own research. Speak to a professional advisor if you think that would help. But hopefully this does help in its own small way. And finally, we are licensed, AFSL number 540697.
Nice. So we're going to break it into a couple of parts today. We're going to go through our core portfolios and then our satellite positions. We've also used a lot of the reports through Sharesight, which is the platform that we use to track all of our investments across all the different types of brokers, both listed and unlisted positions as well. Cryptocurrency, you name it, Sharesight tracks it for us. And we've pulled some interesting data as well around how our portfolio is exposed across different positions. Yes. And I want to talk about some of my drawdowns as well, which is
isn't it your potential drawdowns?
No.
Oh, your actual
historical drawdowns.
Okay, yeah. We should say a big thank you to Sharesight for sponsoring this episode. If you want to join us and use Sharesight to track your investment returns, make tax reporting easier, and as Bryce did, see some of your biggest drawdowns, you can go to sharesight.com/equitymates. And you can save 4 months on an annual Sharesight paid plan.
You won't regret it. All right, well, let's get stuck in, Ren. Core and satellite. Let's start with the core.
Yeah, well, I guess for people who are new to Equity Mates who may have just seen this YouTube video and want to see how we're investing, the structure of our portfolio is, as Bryce said, core and satellite. Core is index tracking, globally diversified, low-cost ETFs. The point of the core is to just try and take the overall stock market's return. And the philosophy behind that is that most investors, even the most highly paid, well-resourced active managers, struggle to just beat the overall market.
Yeah.
So the core of our portfolios just gives us exposure to the overall market. No thinking, just consistency. That's the
sleep well
principle
at night.
Of core. Yeah. Then satellite is the money where we try and beat the market. Individual stocks, crypto, active managers, thematic ETFs, whatever it is, we want to try and beat the market. But the satellite bucket is smaller than the core bucket because whilst we may try and we may hope to beat the market, we recognize that very few people do consistently over the long term.
Yeah.
So that's the structure.
That's the structure. Plain and simple. We should say that if you are starting out, you don't need the satellite approach. There's nothing wrong with just having a solid core that you put in the bottom drawer and let tick away for 40 years.
Yeah. Put in the bottom drawer and keep stuffing more and more into that bottom drawer.
Right.
Stuff it full every time you get paid. Your future self will thank you. So let's start with the core. Why don't I kick it off because mine's a little bit more vanilla than yours. Mm-hmm. My core is made up of 4 ETFs, and they give me global exposure at a very low cost. So to run down the list, starting in Australia, the iShares ASX 200 ETF, IOZ, and that gives me access to the 200 largest companies in Australia. Next up, in America, I've got the iShares S&P 500, which gives me access to the 500 largest companies listed in America. Then we go overseas to Asia. The Vanguard Asia ex Japan ETF gives me the largest shares in Asia. And then Vanguard FTSE Europe shares gives me the largest companies in Europe.
Yeah.
And so what I've got there is Europe, Asia, America, Australia. I've got not all of the world, but the majority of the world, the largest companies in those markets.
Easy.
Easy.
And how has it been performing?
So the great thing about Sharesight is that you can look at different time periods. So let's start with total returns since it started, which is 20.56%.
Jeez, can't complain with that.
Pretty happy with that. Let's tighten the time frame. Let's look this calendar year so far. So since January, return of 15.4%. Pretty happy with that. Put that in a compound interest calculator.
I was going to say, yeah.
And finally, if we want to be really specific, in the month of October, 1.1%.
Nice.
Yeah, not sure that the month to month adds a lot, but
Yeah.
if we're doing this monthly, it's good to track it.
I think year to date is worth it. But yeah,
definitely year to date.
We wouldn't recommend necessarily looking month to month if you're just trying to put something in the bottom drawer and leave it. But for the purpose of this, we'll make a note of it.
Yeah, so 15.4% in the calendar year so far. I think that since first purchase, 20.6% is great.
Yeah.
Obviously, the market's been good, but 15%, 20%. If you can keep that going for a while,
Mate. Well, we talk about historical averages of between 9 and 13. We'll use 13 for the ASX over the last 124 years. So to be able to get 20% for the last, since your inception, as you said, plug that into a compound interest.
Well, I mean, very simply, rule of 72, divide your rate of return by 72 and you can figure out how quickly you double your money.
Yeah.
Let's say the 15%. Let's say the 20%.
20,
you're doubling your money every 4 years.
Yeah.
And I've been investing for more than 4 years.
Yeah.
So, that is just a reminder that if you haven't got started, the most powerful thing you have on your side is time.
Yeah.
Like there's no complexity in this core ETF. There's no exotic positions. I'm not trading in and out. It's just every time I get paid, I dollar cost average into these 4 ETFs. And over the past 4 years, I've doubled my money.
Yeah. So easy. Investing's easy.
All right. So I said my core ETF is more vanilla.
Uh-huh.
Tell us about yours.
Yeah, so mine structurally is not too different. I still have globally diversified index funds that are relatively low cost as well, broken into sort of 4 key sections. So I have Australia, US, Asia, and Europe. Gear is my Australian fund, and it is the ticker is GEAR, and it's a leveraged exposure to the ASX 200. And GGUS is my US index fund, and it gives me leveraged exposure to the S&P 500. So that's why you're saying a little bit more spicy or a little bit more vanilla, because I have leverage for effectively half of my core portfolio. Now, for newbies, what does that mean? It means that the beta shares who run these 2 products, they actually go out and they borrow money within the ETF framework to give increased exposure to the market. So these 2 products are geared between 50 and 65%. What that means is I put in $100, beta shares then goes out and borrows an extra $50 to $65 to give me total exposure of 150 to 165. Now, confusingly, what that means is you actually then get about 2 to 2.5 times the return on a daily basis. So the market goes up 1%, I'll get a 2.5% return. The market goes down 1%, I'll get a 2.5% drawdown. So for me, Ren, I like both of those products because I'm ultra long term when it comes to these. And just like people are obsessed with gearing and the benefits of gearing in property, I think the same should apply to stocks. Unfortunately, there isn't a product neatly available and accessible to everyone that gives us the same sort of leverage. But I think, for me, long term, gearing my core, I'm pretty comfortable with.
So tell us about the returns.
So the returns across the portfolio, total returns for the past 10 years, 23%.
Nice. Okay.
Yeah.
So that's the additional gearing.
Yes. So the biggest return, strongest performer has been the GGUS. It's returned about 30%. And if you compare that to the S&P 500 of about 14% for the same period. So there you're getting that sort of doubling effect from the gearing. Vanguard Asia ex Japan has been about 22% per year. The Vanguard Europe has been about 18% per year, and then the geared Australian equities has been about 17% per year if you compare that to the ASX 200, which has delivered about 9%. So you do get a significant uplift in from the gearing over the long term, but I do want to point out that it does come on the downside as well.
Okay, point that out.
And so again, it's a nice little, well, I don't know if it's nice, but it's an interesting report that I pulled from Sharesight that shows the maximum drawdown that you have had in your portfolio during the time period that you've put in.
Oh, yeah.
So I've put in, this is all for the last 10 years. The maximum total drawdown, and what this means is the drawdown from the peak to the lowest point before it then reaches its next high. The maximum drawdown for my core portfolio has been 55.5%. So I've effectively wiped out half my core portfolio. So then I'm like, wow, that seems pretty hefty. What was driving that? And it was obviously the two geared index funds. So Gear and GGUS both have had maximum drawdowns of over 65%, 65 to 66%. So what that means is I've looked at my portfolio when markets are crashing. I think Liberation Day was a great example, and these things absolutely do, increase your exposure on the downside. So yeah, makes you I don't think it's making me reconsider leverage, but it certainly makes you think about asset allocation and the use of leverage as you progress through your investing journey, and you can start to understand why, as you get closer to retirement age and those sorts of things, you definitely want to be creating a portfolio that wouldn't be having drawdowns of 55%.
Yeah, and I think the thing is, if you're going to invest in those products, you have to go in eyes wide open that could happen, and that you've got to be willing to ride it out.
Absolutely.
Yeah.
I think the worst thing I could have done is been unaware that was an eventuality and sold on the way down, because I'm losing out 60% and then missing out on the upside. So that's the core.
So look, I think, to sum up the core, we've spoken about it before on the podcast, Equity Mates Investing. We'll definitely speak about it again. The challenge for us making content about this is that nothing really changes, but that is by design. Yeah. And I think the takeaway, and people have heard us say it before, and we're going to say it again, it's like, if you are trading in and out of your core, you're beating yourself. You're defeating the whole point of what you're trying to do. Good core investing is simple, it's repetitive, it's boring, and ideally it's automated, so you don't have to worry about it every fortnight or every month. You can go and do more interesting things with your life if you're not interested in investing, or you can keep the interesting stuff to the satellite portfolio, and this can just tick away in the background. You can get the market return. You're not thinking, you're not doing anything, you're just investing.
Yeah, exactly. So with that said, let's move to, I guess, the part of the portfolio that will change far more often than the core portfolio. And this is our satellite portfolio, where we have the opportunity to try and beat the core.
All right, well, I started with the core, so why don't you start with your satellite? What's in your portfolio? Okay,
well, I mean, for astute listeners, they're going to know my portfolio pretty well, because not a lot has changed. So for new listeners, I have 8 positions in my satellite portfolio now, which are a mix of different asset classes and funds. So I've got some individual stocks, I've got cryptocurrency, and I've got some active and thematic ETFs and fund managers. So let's run through my individual stocks first. So I've got Supermicro, which we've spoken about on the show and has been really caught up in the AI wave. I have Google, and I have Berkshire Hathaway and Eli Lilly. Now, Eli Lilly is one of the big players in the GLP-1 weight loss space. They go up against Novo Nordisk, which has Ozempic. Eli Lilly's product is Mounjaro. And again, we've spoken about these guys on the show, but I have a good, big sort of long-term thesis that the impact that these drugs are going to have and the uptake throughout society. So still very bullish Eli Lilly. In terms of thematic ETFs, I have SEMI, which is the Global X Semiconductor ETF. Gives exposure to the semiconductor theme. A lot of the underlying companies are related to the semiconductor thematic. And then I have ATEC as well, which is the BetaShares ASX Australian Technology ETF. It's an index-based ETF giving exposure to Australian tech. I really like that ETF. It effectively is sort of top quality Australian companies, ex-mining and the banks and the like. Then to close it out, I've got a larger exposure to Bitcoin, and I say larger because I bought it a couple of years ago, and have just let it run. And then I have an active manager who is looking at global small and mid caps. Fairlight is the name, and they are an unlisted active manager who I've given some money to go out and find good quality global small caps. So that's the satellite portfolio. It makes up about 30% of my total portfolio. The rest is in core. But let's turn to performance.
Yes, that's what we want to hear.
That's what we want to hear. So for the last 10 years, it's returned 38.4% per annum.
Yo, put that in a compound interest calculator.
Yeah, so pretty happy with that.
Rule of 72. If you're getting 38% a year, you're doubling your money every 2 years.
Every 2 and a bit years, yeah. Well, yeah, every 2 years. So can't complain with that. 38.4% total return. Biggest contributors. So Bitcoin has been the largest contributor to that performance, 63% per annum. Supermicro's done just under 40. Google has done about 40%. ATEC has performed strongly, outperforming the ASX 200 at 27% per annum. Semi has done 25%, and Berkshire's done 15.5%. And Eli Lilly's done 10%. I wanted to point out Eli Lilly though, Ren, because again, through Sharesight, you can see the breakdown of performance. It gives you capital gains. It gives you dividends. It also gives you currency. Yeah. And so obviously Eli Lilly listed over in the US. So I'm getting exposure to the US currency. Since purchasing it, total return has been 10.79%. Capital gains has actually been just shy of 20%, but I've had a 10% drag from the fall in the US dollar versus Aussie dollar.
Damn.
Yeah. So I think we say that hedging and whatnot for, where we are in our investing journey isn't something that we really put a lot of emphasis on, but you can see here the impact of currency, which I thought was pretty interesting.
Yeah. Yeah.
Not that I've done anything about it.
Well, I mean, you could hedge your own currency in individual stocks, but it would be like a separate trade that you'd have to do. And
not interested in that.
The complexity increases a lot. And I think, generally, so for people who are wondering about currency now that Bryce has flagged that, if, we're Australians and generally we're talking about investing in America, the Aussie dollar can kind of, at the far ends of the range, it kind of gets down as low as buying 50 US cents, and at the top end of the range it gets to parity. 1 Aussie dollar buys 1 US dollar, but those are like quite extreme moments.
Yeah,
the majority of the time it kind of trades in like the mid 60s to sort of low 70s, call it. And like if you're buying US shares and the Aussie dollar's somewhere in that sort of normal range, chances are you'll have an opportunity to sell it a long time in the future when the currency's kind of in that normal range again.
Yeah.
For me, the only time I'm really worrying or thinking about currency is at the extremes.
Yeah.
And so if you're at the extreme where it's parity, 1 Aussie dollar is buying 1 US dollar, then I would take my salary in Aussie dollars and buy US stocks.
Yeah.
Because you should get a currency free kick. On the flip side, if it's down at the low ebb, then you might think about, is now the right time to buy US stocks if the act of taking my Aussie dollars and buying US stocks means that I'm locking in like that low currency rate.
Yeah.
But outside of those extremes, I think the sort of it's not illogical to not stress too much about currency.
Yeah. Now, I just wanted to touch on 2 final things before we turn to your portfolio. Firstly, just exposure across the whole portfolio. Sharesight runs an exposure report, which gives you a total breakdown of all of your individual holdings, looking at where they appear in multiple ETFs or funds as well. So you can actually get a view on your exposure at an individual stock level.
I think the classic use case for this is questions about ETF overlap.
Absolutely.
When someone owns S&P 500, FANG,
MSCI
All World, maybe an ethical
DHH,
ETF, and then it turns out that all the top holdings in all 4 of those ETFs like Nvidia, Google,
Yes.
Apple,
Yes.
Microsoft,
Yeah.
this report will show that clearly what your overlap is.
That's right.
So, what's your overlap?
Well, the good news is there's not a lot, which I'm happy about.
Nice,
Yeah. So it obviously aligns with my top positions. So Bitcoin is my largest. Google, there is a little bit of overlap, but because of I own it direct, and also it appears in one of my ETFs. But then outside of that, there's very little overlap, and you can see on the screen it just lists out all of the stocks individually. So I'm pretty happy with that. And that comes down to the fact that we manage our core portfolios at an ETF level to ensure that we're getting the exposure to geographies rather than sort of the all-in-one approach. So worth looking at if you do have Sharesight. And finally, Ren, to close out, I did look at my maximum drawdowns as well, and I think it's very important to know what you're invested in and what you're up for. Bitcoin, the largest drawdown I went through, despite it pumping out 60% per year, for me, the largest drawdown I went through was 73.6%. So we are no surprises there. And then the largest drawdown across my entire portfolio, though, was super micro. 84% was the largest drawdown I went through. However, it's been the second largest contributor to my total return. So again, know what you're invested in, and understand the volatility that you might expect. And if you're willing to take that risk, then the rewards might be there. So that's me, Ren. We're going to take a very quick break, and then on the other side, we're going to look at your portfolio, Ren. What's in your satellite and the returns that you've been seeing. We'll be right back.
Well, this episode is with thanks to Sharesight.
Tracking your investments shouldn't be complicated and overwhelming. Whether you're tracking multiple portfolios or just one individual stock, keeping tabs on your performance, your dividends, and your tax can be time-consuming.
Sharesight makes it easy. Automatically track your capital gains, your dividends, your foreign currency impacts, all from a simple dashboard made for Australian investors.
So stay on top of your investments, start making informed decisions, and spend less time in those spreadsheets.
Sign up today at sharesight.com/equitymates and get 4 months free when you sign up for an annual paid plan.
Alrighty, well, let's get back into it. I've gone through my satellite, Ren. Let's turn to yours. You treat yours a little bit differently to mine. So how about we start with your structure first?
Yeah, so I split my satellite into 2 buckets, active and thematic, and individual stocks. And the logic there, I guess, is I still check active and thematic, regularly, semi-regularly, but it's less active in terms of how much I'm thinking about it and how much I'm doing. Yeah. Because, the thematic ETFs I'm investing in should still play out, they should still play out over years. And then the active managers, you want to give them time to really understand if they're doing well, great. If they've had a bad year, was it just a bad year? So it's just for me, structurally, I kind of think of them as different buckets.
Yeah.
So let's start with my active and thematic. Honestly, pretty underwhelming. So since inception, it's delivered 14% a year, which is fine. But I think that the key takeaway, it's lower than my core has delivered.
Yeah.
Which does actually align very neatly with our point, which is it's very hard to beat a core portfolio. But I think if I look at more recent data, it is more disappointing than that. So, we're talking monthly here. In the last month, it's delivered 1.5%. But again, monthly returns don't really mean much. Calendar year, it's delivered 7.3%, which is...
So that's even underperforming ASX alone.
Yeah.
Yeah.
Yeah. Well, so I benchmark it against IVV just because that's sort of, that's the American market. But yeah, I kind of think about benchmarking it as what is the alternative that I would be. Yeah. So against IVV, which has done 11.3%, this is underperformed by 4 percentage points this year.
Mm. Does that bring into question?
100%. Yeah. So I think, if we do this consistently every month, you'll see things change there.
Jeez, you wouldn't want to be the active manager getting the flick.
But I think you can't jump at shadows.
Yeah.
And you have to recognize that the global stock market index is being buoyed by a few really incredible companies that are riding the AI boom hard. Nvidia, Apple, Microsoft, Meta, Google. And active managers are generally going to be underweight the biggest names at the top of the index just because they're trying to be differentiated and trying to be active generally. And so being short term in your comparison is somewhat unfair because we know that markets will change over time and there will be periods where different strategies will do well. And this is just a period where tech and indexes that are dominated by tech is doing well.
Yeah.
Fair to say?
Fair to say. It doesn't take away the fact that it's been your core has still beaten it for the last 10 years. It's like, sure, but there's probably some I imagine there'd probably be some active managers in there that have actually outperformed, and then some that are really dragging. Yeah.
So let's move to my individual stocks because I think that's probably more interesting. So I'm going to start with this month's return and then go back from there because October was tough for me.
Okay.
So down 4.5% in October.
Right.
Yeah. Now, in terms of what were the big contributors to that, so crypto didn't have a good October.
Yep.
But I also have two relatively large positions that also got whacked. So Catapult Sport.
Yep.
Which is, for people unfamiliar, you'll often see professional sports people wearing like the Catapult sort of sports bra looking thing, or they'll have a little device in the back of their jerseys. It tracks athletes' movements on the field, allows for analysis post-game, tracks how hard they're working, if they need rest. Credible Australian company, down 10% in the month.
Oh.
And then C Limited, the Singaporean, the Southeast Asian e-commerce giant, down 15% in the month.
Right.
So I had a couple of big positions that got whacked pretty hard. So if we zoom out in the calendar year, my total return 18.3%. Again, under my core.
Yeah, interesting.
Maybe I should stop picking stocks. Maybe I should just go back to my core. Now,
what was dragging it down for the year?
So two big drags for the year. Novo Nordisk.
Yeah.
So you mentioned Eli Lilly before.
Get rid of it.
I own both Eli Lilly and Novo Nordisk. My view as an investor is you don't have to choose, and there can, in some fields, in some technological revolutions, which is what this GLP-1 drug is, there can be multiple winners. But if we look at my portfolio this year, there's only been one winner, which has been Eli Lilly, who actually hasn't done that well. They've been pretty flat. But yeah, Novo Nordisk has been down. And then the other big detractor this year has been WiseTech.
True. It's got hammered.
So for people unfamiliar, WiseTech is an Australian shipping and logistics software platform, and they've been an incredible Australian company. But their founder has had some troubles recently.
Personal issues.
They were personal issues. And so when it was just personal issues, I held through thinking that like it didn't change the underlying company. The quality of the company didn't change. Now the founder the police raided their office, and there's questions around some of the share trading of the founder and a couple of insiders. And the shares got whacked. The challenge for me is the thesis hasn't broken. And so it's hard to it's hard for me to get conviction to say it's time to sell. But I am also very mindful that like the longer you hold a stock that's going backwards, there's an opportunity cost. And also, sure, maybe the shipping logistics thesis hasn't broken, but like a lot of that thesis was tied into what Richard White built. And all of these troubles keep piling up, the risk that he is no longer there increases. So,
tough one.
Yeah, I don't know. I'm on the fence about it. So in terms of some of the major contributors for the year, let's start with the two companies I mentioned earlier that were detractors in the month of October. So year to date, C Limited is up 50% and Catapult is up 80%.
There you go.
So a reminder that if you're looking at too short-term a time frame, you might miss the forest for the trees. My biggest holding in my portfolio, Axon Enterprise, is up about 21% this year. So it's had a decent year. And a couple of other notable names just to close out some of the big contributors. Shopify up 60% this year. Spotify up 40% this year. Coinbase up about 30% this year.
Solid.
Yeah, so there's been some good names in there as well. Yeah. But I guess to close it out, let's zoom out and look at the longer term returns. So from inception back to 2018 when this portfolio started, 66.5%.
Solid.
Yeah.
Throw that into a...
I know, but like it's unrealistic to think that continues. Obviously, crypto since 2018 has been a big contributor to that as well.
True.
Yeah.
True.
So,
doesn't matter though.
Oh, I'm not. I'm just saying, like, I don't expect that to continue.
I see what you're saying. I see what you're saying.
To close out, Sharesight have a contributions analysis report.
Yep.
And so you can look at what individual holdings have been the biggest contributors to your returns.
Yep.
And also the biggest detractors from your returns.
Yeah.
And so you can look at it as both percentage return.
Yep.
So just purely the stock that you held or the ETF that you held, how much did it return while you held it?
Yep.
And then you can look at it as a contribution to your overall returns.
Gotcha.
Now, the way that those two are different is if you've invested more in a stock and it grows less, because you had more in it, it will be a bigger contributor to your returns than a tiny little holding that grew more but didn't contribute as much to your returns.
Yes.
So I had a look in terms of best returns. It's actually a company I don't hold anymore. Do you want to try and guess what
I
it
reckon
is?
it would be your Facebook.
Yeah, Meta.
Yeah.
Yeah. So, I got on Meta at its low ebb in like late 22.
Yeah.
And so that's
when it hit like $90 or something.
I can't remember.
Yeah,
but it was good. Yeah. So that's been the biggest contributor to my returns. That's been the biggest percentage return.
Yeah.
But then just to go down the list, it's still a number of stocks I own: Catapult, Axon, Bitcoin, Shopify, Spotify, Coinbase. Transmedics is in there.
Yes.
Supermicro, ResMed, Ethereum, C Limited. The list sort of goes on, and this is all stocks that I've owned, not just stocks that I currently own.
Yeah.
But in terms of contribution to the portfolio, Bitcoin came in at number 1, which surprised me.
Surprising. Yeah.
Axon came in at 2, Shopify, Spotify, Catapult rounded out the top 5.
I reckon Bitcoin would be the same for me.
Yeah. If you're watching on YouTube, the charts that we've put up are the percentage return rather than contribution. But you can sort of see there's a pretty wide distribution from best performers to worst performers. Some of the worst performers in terms of my portfolio, one that Luke Larrative suggested.
Oh, yeah.
Botanics.
Oh, yeah. Ben suggested.
Yeah. It was down 60% while I held it. Luckily, I only invested a tiny bit.
Yeah.
So the contribution to my portfolio was minus 0.5%.
Okay.
But still. Novo Nordisk, we've spoken about. Magellan Financial Group.
Yep.
MinRes, MicroStrategy or Strategy. A few names that we've spoken about there.
Nice. Well, there you have it. Insight into our portfolios, what we own, performance, it's all in there. And I think, as you can see as well, plenty of good insight from the Sharesight platform, which we both use to track our portfolios. So keep subscribed to the channel, because we'll be trying to do this as each month goes on. We'll be talking about how our portfolios have changed, although we should caveat there's probably not going to be much change in our cores, but there will be some change across the satellites as well.
Yeah.
And so make sure you're subscribed and you like this video as well, so you get notified when the next one comes out. Big thank you to Sharesight. If you would like to sign up to the platform, you can head to sharesight.com/equitymates. If you sign up to their annual paid plan, they'll give you the first 4 months for free. Pretty good deal to get started. There is also a free component to it as well. If you just want to trial it, you can put in up to 10 positions to get started. But Ren, that does us. We'll pick it up next episode.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.